Hello and welcome to EduFund. In today's episode, we have a very special guest with us, Meeta Shetty from TATA Mutual Fund. Meeta is a fund manager at TATA Mutual Fund. She manages the Focused Equity Fund, and along with that, she manages the TATA Digital India Fund and TATA Pharma Healthcare Fund. Meeta has 16 years of experience. Prior to joining TATA, she has worked with Kotak Securities, HDFC Securities, and Asian Market Securities. Qualification-wise, Meeta is a CFA charter holder from CFA Institute US and is a bachelor in economics. Welcome to the show, Meeta.
Yeah, thank you.
Let's start with the Focused Equity Fund. Why don't you throw some light about the process of selecting stocks in the Focused Equity Funds and how do you go about managing the risk in this kind of a fund?
Thank you, Neeraj, for having me, and thanks EduFund team for hosting us. So I think when we think of focused equity or a focused fund, it's generally perceived as a PMS, a quasi PMS kind of fund, because of the nature and the restrictions on the number of stocks, etc. we can hold. But I think how I look at this fund is that I look at this fund as an opportunity to actually generate higher alpha versus any other diversified fund. The idea is to have a very balanced approach in terms of having a compounder and an alpha bucket. So when I say compounder and alpha bucket, basically what I mean is that in the compounder buckets would be companies which have a long history of proven track record. They've gone through cycles and still kind of emerge strongly over a period of time. And they have a consistency in terms of how they perform. Obviously, valuations are slightly on the higher side for such companies, but it definitely gives me a very balanced outlook when I look at my return generation over the next time frame I'm looking at. So that is my compounder bucket. Basically, it will just keep compounding. There is no re-rating element to that. Then comes the alpha bucket. Basically, alpha is nothing but GAR as a philosophy, wherein I am trying to zero down on names or stocks which not only have the growth potential but also has an angle of re-rating to it. Now, it could be a stock where things have not gone right and things are suddenly starting to emerge in the right direction, or an industry which is coming out of a long cycle of downside, or there is a management change which is kind of moving to a different strategy, or anything which is basically just pumping up growth versus what its historical growth is. And because of that, there is a re-rating element, and that alpha bucket is what does the heavy weight lifting as far as the return for the focused fund is concerned, right? So compounders give me a steadiness in a volatile period. Alpha actually does the heavy weight lifting for the return generation. So that's my approach to look at or manage focused fund. It's a complete bottom-up stock picking here. I don't actually look at sectoral, or I don't take sectoral calls here. Yes, but today if you look at the fund, you might see that we are extremely overweight on a power sector. But that's more by an outcome of the way I have been picking stocks.
When you say bottom-up stock selection is the process of evaluating the stocks and you do not take sectoral bets, would you have any sectoral biases towards the market capitalization, or that will also naturally flow into?
Not really. So if you look at today, the split between market cap division into my focused fund, around 50 odd percentage is in the large cap and the remaining would be mid and small. Now, one would perceive that the large caps would be compounders and the mid and small would be alpha. But if you look at my fund and the way I am looking at it, there are one or two names in the large cap also which actually are heavy weight lifters for me in terms of alpha. But there are few names in the mid also which actually fall into compounder bucket. So it's actually not very driven by market cap.
You mentioned that around 50% of the allocation is roughly towards large cap, and people are talking about markets are very expensive because valuations are very, at a very high premium at 73,000. So how do you manage that? And what is your take in valuation when valuation is concerned?
So I think looking at valuation in an absolute number probably would not give us a very good picture. I would generally tend to look at them on a more relative basis. So I think when I look at Indian market valuations versus the emerging market basket, which is generally a faster growing economy similar to what ours is, there I'm seeing the premiums are in the range of around 85 to 90% at this point in time. Okay, historical averages have been around 60. We've also seen as high as 110 odd or something like that in the last 3 years. That was for a short period though, but we have seen that number. Now, when I look at relative and the way the Indian economy is perceived to be growing versus the other economies, clearly I think we warrant a premium and slightly higher premium than in the past, because we are seeing what's happening with China and the other economies which were actually fast growing, but today I think India stands tall in terms of all the numbers. So I think the 60% going to 85-90 is more or less somewhat, I think, validated. So I'm not too worried on the valuation. Yes, there has been a very strong rally, and probably re-rating from here is something that might not happen.
Yep.
I think that opportunities from here on are going to be more tricky in terms of stock selection, and we have to obviously probably might not find alpha too much as we've been doing over the last 2 years. But I think there are always opportunities in the market as far as alpha is concerned.
You mentioned about focused equity being a little concentrated kind of a portfolio.
Yeah.
And we have seen a very significant flows in equities. So does that restrict in some manner your capacity to take exposure to different stocks, or how would you manage that scenario?
So I think given our size, actually we are in a very, very sweet spot because our size is shy of 2,000 crores and we still have a long runway, and our size actually gives us a very good opportunity to swing from opportunity from alpha to compounder to alpha, agnostic of market cap. So to your question, clear answer is no, given that we are in a very, very sweet spot as far as size is concerned.
Let's talk a little bit about a thematic fund which you manage. You manage two sectoral funds. One is a Digital India Fund and another is a Pharma Fund. And I think if you talk about the overall, if you look at the last 5 years, we have seen a significant activity in both the sectors. Digital India also because of the mission of the government around that, and Pharma because of COVID. So how difficult is it to manage a thematic fund or sectoral fund? What are the challenges which you see? And what is your viewpoint over these two funds over the next couple of years?
So I think when we talk about thematic funds, yes, there is always a limited amount of stocks that I can go to versus what I would do in my focused fund. So clearly that is there. But over the last few years, whether I look at my digital fund or my pharma and healthcare fund, there have been a lot of options in terms of listing. Like for example, there have been a lot of platform companies which have got listed in the Indian tech space versus earlier what we were. Earlier we had only the few go-to names on the services side. We have a lot of fintechs which are coming in. So I think that horizon is actually widening in terms of where I can go. Even when I look at pharma and healthcare, a host of hospital companies and healthcare companies have actually got listed over the last couple of years. So yes, the challenge probably was higher in say about 4 or 5 years back when I started managing these funds versus today. There is a broader basket. So I think the challenge is more or less, abating over with time, I would say.
Talking about Digital India Fund, if you look at that is a very sectoral fund, and with only one sector or maybe a couple of allied sectors, the risk is naturally going to be a little higher. So how do you think an investor, particularly a retail investor, should take exposure to these kind of funds? And where do you see the investors creating more value for themselves? Like, will it be a short-term period or will it has to be a long-term period? Should it be a staggered approach? Should it be a lump sum? What is your take on that?
Okay, so I'll take the last part of your question first. I think the approach always has to be medium to long term. I don't think one should have a short-term exposure as far as equity investing is concerned. Because I think, when even I analyze companies as a fund manager, the idea is to see that how the company is going to do in the next 2-3 years. Within a span of 3-6 months, stock prices may not necessarily be in sync with what the company is doing, right? So idea is always to look at stocks or investing into equities from a medium to long term. As far as now coming to the digital part or the question you asked me on the outlook, I think the world is moving towards digitization, and COVID actually pushed that journey a couple of years ahead. Whatever we were seeing in terms of say cloud migration or an adoption of AI, robotics, etc., all of that probably got a lot of fillip because of COVID, because that is how we were functioning, and companies who were lagging those investments had to kind of push themselves to do that. And now that journey is on, I think it's actually firing on all counts. Yes, there has been a kind of a pause by the companies sitting in the US over the last 2 years because what's happening in the US economy in terms of interest rates and worries of recessions, etc. But see, you have to understand and look at it that today every enterprise, whether small, big or large, Going digital is not a choice. It's a compulsion. You will have to do it, or or somebody else will kind of overpower you, and you might become irrelevant in that industry or a segment. Customer satisfaction is at the core for every industry, and you cannot do that without going digital. So any aspect of business, whether internal or external, need digitization today, right? So I think it's a multi-year journey, and if investors are looking to benefit from this journey, then I think Indian IT provides a very good platform for that, because we take a lot of work, at our home IT services industry in India has been growing really well, and we have actually showcased our strengths time and again. At every technology change, Indian companies have shown that they can, go up the value chain and adopt to these changes. So I think we've been very, very resilient over the years, over the last 2 decades, that we've shown our strengths. And going ahead also, I think that is how I think things will unfold. So if one wants to benefit from this, one has to look at some allocation to this segment, I would say. On your question on staggered or lump sum, I think these are more structural stories, and a staggered investment approach will actually make a lot of sense. Yes, but if there is a sharp correction, for that matter, not only in IT but any other sector or a diversified fund that an investor is particularly investing, then I think during a sharp downturn, one can look at lump sum as well.
Understood. When you talk about Digital India Fund, since we have only one sector, have you seen more value being created at a large cap level or a mid cap level versus a small cap level, and which area of the market are you trying to focus more?
So I think if I look at the last 3-4 years, growth in the mid cap and small cap was faster or higher, and hence the value creation actually was better over there. But it's not that large caps have not created wealth. I think there have been opportunities in the large cap, alpha opportunities in the large cap, where we've seen massive amount of re-rating and growth picking up as well. So I would not say large caps have not, but because of the growth, higher growth in the mid and small, certainly those have created a lot of wealth. But henceforth going ahead, I think growth is more or less getting aligned. There are very few mid and small caps now which are actually an outlier, in the industry. So now the growth is more or less in sync. So now we probably see more balanced alpha generation on both.
Let's talk a little bit about the pharma fund now. COVID was a very, one-off event, and that has changed the entire structure of the way people function. People have started, moving to Zoom calls, and people have started, adopting to a hybrid culture. So how have you seen the entire pharma industry changing because of COVID, and where do you see that over the next couple of years?
So I think COVID did give some push to the pharma sector because we all were more careful on what we are having. We all were taking our vitamins and supplements, which probably, at least in India, there's not that culture. Outside India, you do find that culture actually. So that was there, but I think that was more or less for that time frame. We all have got back to our normal lives again. But when I look at the broader horizon, I think there are 2 legs. One is Indian consumption of drugs, medicines, etc. So lifestyle changes and lifestyle, we have more sedentary lifestyles, etc. are driving higher incidences of, say, blood pressure or diabetes, etc. Those all, and because we want to live a healthier life, we also want to ensure that we are more healthy and definitely take these medicines if need be. So that is one underlying, thing which is kind of keeping the growth rates for the sector at a reasonable level. Second element is the export element, because we export a decent amount of, so if you have to give you numbers, almost 25 billion worth of drugs we consume internally as Indians, and almost similar amount, which is 25 billion, we actually export outside. So export is also a very huge market there, and Indian pharma industry has actually gained a lot of strength in terms of medicine manufacturing. The cost at that we manufacture and the quality that we provide is actually unmatched, and that's why today Indian companies have a higher volume share in the US economy. So to your question, just COVID did not change much, but yeah, over the longer term our strengths were stronger, and COVID probably made us more stronger in terms of our pharma industry.
Talking about the pharma sector structurally, if you see that it combines, it consists of multiple segments like bulk drugs, formulations, APIs, and even biopharma is there. So many things are there which are there, and patents is also playing a very important role. So where do you see most value creation opportunity, and how do you think Indian companies are faring in that?
So I think pharma, we have not been very strong in terms of API or say the chemicals which get into the medicines. We have showcased our strength on the end, whatever tablet or a injection or a capsule, the end medicine. So our strengths were lagging on the API side, which I think the government has also kind of realized our dependency on our neighboring countries is very, very high, and we want to ensure that we are self-reliable. We also become a hub for export on the chemical side. So a lot of thrust is getting there in terms of our manufacturing capabilities on the chemicals. So I think there possibly some good opportunities can come up. Too early because these are just starting to unfold. But there is that segment actually definitely looks good. Second sector actually would be not pharma but on the healthcare side, because I think when I look at hospitals the way they were a couple of years back, these companies used to hardly make ROE in double digits. And the capex cycles used to be very bulky and heavy, and companies were never able to actually turn very highly profitable as they are today. Today, when I look at management's approach, they have actually turned asset light. The ROE, ROCs are actually inching up towards high double digits. And if you look at the Indian population, our incomes are also going higher, and we are looking for a better quality in terms of our requirement for hospitals, etc. So both of these things actually are making the healthcare segment or the healthcare companies, I think from a longer term view, they're looking far better.
Again, the similar question to what I asked for Digital India Fund for pharma also. Are you seeing value creation in a specific market cap? Like, is it large cap, mid cap, small cap? And is it more propounded in terms of hospitals versus pharma?
So, I think that as far as large cap, mid cap split is concerned, on the pharma side, we're actually heavier on the mid and small. That's because I think there are a lot of small companies or mid companies in the chemicals or the pharma space. Even on the hospital side, we have maximum companies on the mid-small size. So clearly that skew is also seen on the fund that I manage. As far as opportunities are concerned, as I said, healthcare and chemicals probably are wider also in terms of opportunities or names. And there are a lot of things moving in the right direction as well there.
How do you manage risk in these kind of funds? These funds are very sectoral in nature. Naturally, the risk is going to be definitely a little higher. So how do you manage a risk when it comes to managing the funds?
So I think, as I said at the start, that the compounder and the alpha bucket, that approach actually cuts across all the funds that I manage, and my compounder bucket would help me in a volatile time. So that is one way to balance risk when the markets turn a little volatile. Second is that so wherever I think that the alpha has already played out, then I would want to take some risk off the table and probably move to a more compounder bucket or find a new alpha opportunity. And that's a continuous process, of course. It's not that there are timelines for it. So we don't shy away from taking those bold calls if we think that the risk is higher. But otherwise, the compounder and the alpha bucket more or less balances the risk in a regular time frame.
Okay, that's all from my side. Meeta, thanks a lot for your time, and it was wonderful having you. And thanks a lot for for sharing your insights.
Thank you so much. Pleasure.
Ladies and gentlemen, that's Meeta Shetty from TATA Mutual Fund, who manages the TATA Digital India Fund, TATA Pharma Fund, and also the Focused Equity Fund. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.